Good morning, ladies and gentlemen. Well, we've had a very interesting week and quite a revealing week, which basically tells us that the market is on recession watch, whether it's merited or not. I don't think it's merited right now, but I think that it'll come later on in the year. The only thing that's interesting from the model score perspective is that it still refuses to go into negative territory, which tells me that everything so far that we have seen is a bit of a correction which will retrace, and that we are not yet ready to have another leg lower in equities. But we will look at all the details and I'll tell you what I think has been happening over the past 2 or 3 weeks and why, and how to determine when we can start expecting different price action. Everything in the past 6 weeks, really towards the end of June, has been a disinversion of the yield curve trade. And disinversions are what happens when you are looking for recession. I'm not sure that we are that far advanced that we need to look for recession. We are certainly in a period of lower growth, but that does not mean that we are anywhere near a recession. Just because you have a lower rate of growth does not mean you have a contraction, and the market is at the moment trying to gauge whether we are indeed in lower growth or whether we will slip into recession. I don't think we will slip into recession for the very simple reason that we are not getting the kind of data that would indicate it. Now, I've been telling you for quite some time that equities are trading with the 2s, 10s. And that is indeed what happened. They bottomed just about at 0 on Monday. And then we tried to go sideways and we fell. And then at 8:30:01, when we got the data for weekly claims, we realized that weekly claims are just fine. They're not showing any kind of acceleration in the unemployment front. And what did we do? We rallied. And what happened over those 2 days, Thursday and Friday? Well, equities rallied. And we closed the week unchanged in equities. And where did we close the week in the 2s, 10s? We closed it actually a little bit higher. This is telling me that we are not going to get a huge period of weakness in equities, and that you're basically looking to buy the dip there. Where we'll return to, well, I think we'll definitely return to the 16 level. I think this period of very strong steepening is probably over until and unless we get data which starts showing that it's more than a period of lower growth. Now, as I said, huge difference between lower growth and contraction. This is all we've got. We tried to disinvert, we got to 0, we stopped. That to me says that we found some kind of a medium-term low in equities and risk assets, and that now we will meander up and down, waiting to see if the data turns further or not. Let's go on to the individual tenors. We got out right at the bottom of the 2-year note. 369 was the level, and now we are basically retracing, and I would not be really all that shocked to see on stronger data us going all the way back up to 426. I would be shocked if we went through 426. We know that the Fed will ease. The question for the market is not whether the Fed will ease. the question for the market is, what is the terminal rate? Now, how will the market determine that? Well, it'll determine that via the data that it gets. If we think that all this is normalization and we are going from restrictive policy to neutral policy, this cycle is going to be quite shallow. I would be very, very surprised if we don't settle somewhere between 350 and 4% as the terminal rate. If the terminal rate is 4%, twos, where are they? Well, they're a little bit above it, aren't they? The 420 would be nice for them. If the terminal rate is lower than the 3.5 to 4% area, and that would necessitate a recession, because in a recession, real rates would go to zero. So Fed funds would be on top of CPI, let's say, and let's call CPI 2.5%. So Fed funds go to 2.5%. Well, where are 2-year notes? Well, they're a lot lower than this, aren't they? They are 20, 30 basis points above Fed funds. And that is the big question for the market. So at 426, I can fight it. At 405, I can say, yeah, it's not too expensive, but at 426, it's definitely worth a fight. Let's have a look at the fives. They've basically returned to where we started the year. The yield curve will be positive if the terminal rate is below the 3.5 to 4%. It could be quite relatively flat if we are at a terminal rate of around 4%. So I'm not going to start arguing with the fives until we start getting back up towards the 4% area. That is where you can start arguing with them. At the moment, they're quite neutral. And I think that all these contracts are going to continue to be quite neutral in a range up and down until and unless we get data that shows that the unemployment situation or the output and consumption is falling off a cliff. So next week we have retail sales and we have weekly claims again. I think the market is going to be on tenterhooks for every weekly claims release from now on. And retail sales, naturally, I think will be very important. I know that some people think that PPI and CPI are going to be important. I think they're now becoming secondary. I think we all know that there is very little chance of inflation accelerating, and it's only a question of how fast it moderates. I don't think it's likely to moderate all that fast because we have very difficult comparisons on a year-to-year and month-to-month basis. So I don't think that those are the numbers that are going to really influence the market. What is going to influence the market is unemployment and consumption. So having said that, tens, the range, these lines are catching the range perfectly. I think it's very, very unlikely that we go above the 416 level in tens. So, you're not going to lose very much money by buying them anywhere around the 405 area. And the third is they cheapened them up for the auctions quite a lot. We got to, this kind of level, and then we rallied a bit. I don't think the rally lasts too much. They're not going to go below 418 for any, unless there's some kind of a panic. So I think we're in this 418 to 435 range in the 30s, and they're going to be quite comfortable. They're going to be the least volatile contract for quite some time. I've started paying a lot more attention to the very short end, and this is the 1 year. I think anywhere near this 468 level is going to be a great buy that you can do in the sofas. This kind of range, 468 to 483, I think there's absolutely zero chance that it breaks. And this is what it did on Fed Day. And I think that that is significant. If we have a retracement to this kind of level, I think the risk reward in being long the SOFA curve is going to be very, very good indeed. So that is what I'm looking for. I'm really turning my attention much more to the very short end, like the 1 year, the 3 months, and so on. And I'm looking for really good levels to get in for the very long term, i.e. holding them to maturity just about, but also, on a leverage basis, getting long the SOFA curve. This kind of level, and this is where we traded on Fed Day, to me, a retracement to that level is going to be very good risk reward market. This was not really a week to look at the European markets. They basically went with the US, but much less so. I don't think that there's any merit in looking to do anything at all next week in the European markets unless you get some stupid levels. Europe is on holiday. It's Ferragosto, 15th to 30th of August. No one's around. There's not a lot to do. So if you get some stupid moves back up to something like 258, 259 in the shats, yeah, probably a very good opportunity to buy it. Anything up here around 230 in the bobble, and anything up to 235 in the Bund. But I don't think you're going to get those moves. I think it's going to be very quiet and basically in the sign of let's just move with the US. Unless the data that the US gets for retail sales and the weekly claims is way out of line, I don't think Europe is going to do very much next week. What is also indicative that we are not in a period of sustained risk off, shall I put it, is the fact that Germany, France, and also Italy, Germany, have basically returned inside their ranges. As soon as there is risk off, they go outside their range, and as soon as the risk off abates, they go back inside their range. The fact that it couldn't stay outside the range tells me that we are not really going to get some sustained risk off. Look at it. These are not the kind of charts that show that we are ready for a big run to the downside in this case, or a big run to the upside in that case. It's telling me more or less that we're going to be stable within a 10, 15, 20 basis point range, and that is all that we can look forward to. And if that is it, then it's not risk off. Equities are not going to move a million miles. As a risk sentiment indicator, I've started really looking at the twos in Japan against the twos in the US. And I think this is an interesting chart, because all these charts that I've shown you basically are turning their 200 period, 200-day moving averages. And it's just a question of what level you get in and when. If we look at a long-term chart of the twos, you can see how far they've come, and you can see that they are basically now in a period where that they are returning. Now, how is that going to happen? Well, it's going to happen with the Bank of Japan staying hawkish and the Fed easing. So to me, it's only a level where you get in there. And that area is here between minus 385 and 413. So that's a 30 basis point area. Let's call it 25 basis points. And what have I told you? I've told you that the market is trying to determine what the ultimate terminal rate is going to be in the US. I think that we know that Japan would like to tighten if it can, probably can't, but the US definitely wants to ease and normalize the real rate and normalize the tightness. Therefore, this kind of area is really going to be very interesting to me, and will follow this kind of area over the course of the next few weeks to see where the absolute best level to get in is. I think that if we see it around the 4% over the course of the next couple of weeks, the risk reward is going to be very, very good, that it returns back up towards, this 350 area and so on, which would indicate that the dollar is slowly turning. Odds are that we probably saw a low in the dollar last week, which will last for quite some time. Sideways to up, I think it's going to be very, very hard to break this 104.05 to 104.30 area. But if we look at the weeklies, we can basically see that this contract is wound tight, and it really doesn't like to remain below the Bollinger Bands, the weekly Bollinger Bands, for long, and always comes back to them. Look at the doji on the weekly, exactly the same as the SPX, right? We returned exactly to where we opened the week. This to me says that we are open to squeezes, and squeezes up to this 104.30 level. And that's all I've got. How does that tie in with what I told you about the rates? Well, it is likely that we've seen the end of the steepening, inverted commas, disinversion trade, and that we are going to get a little bit of price weakness in the short end more than in the long end. So what would you call that? Some kind of a bear flattening. And that helps risk assets and helps the dollar. It doesn't help them to the extent that they are now in a different trend. It just helps them to the extent that they retrace a very big proportion of what they lost during the risk off. And that's all I'm saying to you. I wouldn't play the dollar short next week for the simple reason that I can't see that unless the data changes that we are in recession. The market is pricing it for recession almost, but that is not what we have. We have less growth as opposed to contraction. And that to me says that when the market realizes that, and the weekly claims are not disastrous yet again, they're going to say, well, what have we been worried about? In which case the dollar starts doing better, the short ends of the US start going back up towards, 425 in twos, and then it's time to fight it. I wouldn't fight it down here. I'd much rather fight it at 104.32, and I think the odds of us seeing it in the next couple of weeks are pretty decent. Well, with all the geopolitics going on, gold still could not break higher. And that's another point of triangulation that tells me that bonds are really not going to rally very far, and certainly not at the short end, and therefore to be very, very cautious about bonds and very cautious about shorting the dollar too soon. If the markets really thought that bonds were in a big uptrend in terms of price and down in yield, just to be clear, then gold should be making bigger moves than this. Look at it on a weekly basis, how it's basically been in a 25-20, 23-50 range for what feels like quarters. I mean, these are weekly bars, and you can count them and you can see how many quarters we've been in this range. Many, many quarters. And that to me just says that it's unlikely that we are going to break out anytime soon. In fact, it tells me that we are likely to start stopping people out. There've got to be stops around this 2400 area. And if we get to those stops, it'll go a little bit more and then it'll retrace, which tells me that bonds are probably going to get to higher levels, but that those high levels are buys in terms of yield, right? So bonds go up in yield, this gold falls, dollar goes up a little bit, makes gold come down, and then you buy the stops basically. So I don't think we are likely to remain below 2400 for very long. This kind of area between 2350 and 2400 is an accumulation area, and I don't think that we're going to break lower. A break lower would be very surprising to me and not something that I think is likely to happen anytime soon. DBC held where it absolutely had to hold, which is 2175. This level is becoming so important, isn't it? What does it tell me? Well, not a lot. It just tells me that we are not in a period of disinflation. Because if it starts coming through there, then we really are in a period of disinflation. This is, the yearly lows. If we now start consistently breaking the yearly lows, we're likely to come down all the way to 1955. And that is, what does that tell you about inflation? It tells you that it's about as dead can be. So I don't think that we are imminent in a move here. I think that it's far more likely that we range trade for a little bit. It doesn't like to remain below the Bollinger Bands and returns eventually, whether it's, a few weeks or whatever, it does come back. But this is not a chart pattern which in any way anticipates some strong move higher in commodities. It's basically saying we are stuck. If anything, we have some weakness, and that is not where we get periods of trending bond prices up in yield. It just isn't. It just does not triangulate well with that kind of scenario, and that is not what the bond charts are showing either. They're showing you that you're looking for levels to get long in terms of contract, in terms of price, and that is what DBC is saying as well. Any market which basically range trades like this, when it has every opportunity from a geopolitical standpoint, or from the inflation hawks, people who think that commodities are going to go to the moon because inflation. Well, this negates all of that. It just tells you that the market does not agree with those views, and therefore I really would leave this alone. I just don't see any benefit in owning it. Let's start the review of equities with my clean chart with all my important levels. To me, it's significant that this market really could not stay below 5180. To me, that was very, very good support, and it showed that indeed it was. This little bit of panic here, it was just a little bit of panic, and we opened and we went up. And we held, right? We held all week, even on the big down day for no reason whatsoever. Well, where they tried to bury me but lost the battle the next 2 days. It just, it was the very, very good support level. What do I think now? I think that unless the data is weak, and I'm talking about retail sales and I'm talking about unemployment claims, so weekly claims up, unless we get that, we will trade this 54.47 area again and fill that gap and probably find it very, very hard to go through there. I don't expect it unless the data is stellar. I think that a lot of people will get stopped out by a move like that. I think a lot of people got short at the wrong level and they're caught, and therefore the market will try to make them, stop out at that kind of level. But I think that even if we go to something like 54.90, we probably close the week below this 54.47 area. That's what I think. I think the market is going to have very, very tough time breaking through these levels, and a very easy time on any kind of weak data like retail sales weak or unemployment claims high to come back and fill these gaps if it leaves any gaps. And certainly this gap down here to around 51.97, what it is. But I think this is the pivotal close for the week. 51.8, just let's call it 5200. I think it's going to be very difficult to close below there unless the data says that we're going into some kind of recession. Technicians are going to say, oh, look, it's a wedge, it's going to break down. Leave all that stuff for the morons. This market is now a fundamental data-driven market. You need data to confirm the fears of recession. Otherwise, this turns into an ABC kind of correction, whether, unimportant whether it is that or not. But it just turns into a run-of-the-mill correction where the market has doubts about how far, the lesser growth was. Was it intense? Was it less intense? And the market was arguing. What cannot be argued is that we are in a period of lesser growth than we anticipated when we were doing this. And therefore, I don't see the market really sustaining above here because there are just too many doubts about still. When in doubt, zoom out. And this is the monthly chart of NDX. Found support exactly where it should have found support. I don't think that this market is ready to fall either. I think it's far more likely to fill all these gaps up to around, say, 19,000. And it's going to find it hard going after that. That's all that can be said, and that mirrors the SPX quite strongly. So if SPX and NDX are going to be mirroring each other and not one strongly leading the other, then that indicates stability. So if I had to guess what retail sales are going to be, and if I had to guess what, gun to head, what the weekly unemployment claims are going to be, I would say they're going to be in line. And people are going to be reassured that all it is a period of slower growth as opposed to tipping into recession. That's what the price action is actually saying that the consensus view at the moment is. So I'm really looking for these kind of levels to trade somewhere around 19,000 to 19,200, and that should be enough. Let's talk a second about the VIX because I think it's important now. And let's say what the reality is. We never traded up here. We never did. That was a print caused by a one put option deep out the money that the market didn't price correctly, and it was a bid offer spread as opposed to a trade. So I really wouldn't completely disregard anything above, let's say, 45. And let's have a look at how what this indicates. This indicates so far to me that all we're seeing is basically a run-of-the-mill correction. What happens in run-of-the-mill corrections? VIX spikes to around the 35, 37 area, which is exactly where this really stopped and never went further. And then it falls down and it falls back down to this kind of level very, very quickly. And that level is somewhere around the 18, 17, 18, who cares? And that is precisely what we did last week. We could not sustain anywhere near 30, and we came down and we closed at 20. That is not the kind of thing that happens when people are truly, truly afraid. It just isn't. That tells me that this was a one-off episode and that you are more likely than not still looking up in equities and in risk. That the episode was exaggerated by many things, Japan being one of them, and that you are really looking for numbers which reassure people. And this is completely going to be data driven, right? And I hope I've made that clear. But what it's saying is that the market is anticipating inline numbers, nothing that is going to make the bond market or the equity market completely turn and look for recession. I just don't think we're there. I think we are far more likely to get inline numbers which reassure. Let's have a quick look at Nikkei as well, because it's becoming very interesting. I think the battle is going to be at 37,000. That will be the battle for control, and I think that we will trade there many times, because this 200-day moving average is going to be difficult to turn, and it's only going to turn if we have a lot of time below it. I think that we will definitely trade this level many times, and that also fits in, triangulates with my view of what SPX is going to do. It's going to try and fill all the gaps, and I think that this contract will also try to fill all these gaps up to 38,000, but really it'll trade 37,000 many, many times, and then over time it'll make its mind up. I did buy some on Monday, and I got rid of it far too soon. But I think that 37,000 is the level where you no longer want to own it, simply because it becomes too dangerous. But it just triangulates very well with my view of what SPX is going to do next week. For those of you who like to trade the topics, I think these are the levels: 25.58 to 26.36. I think this is the kind of retracement area that's going to get sold, and then you come down here and then you see. But it'll return to these kind of areas for quite some time. I think the panic there is over, and that's the box that you no longer want to be involved in, or even short, looking for short-term pullbacks. Funnily enough, Europe I like as well. It held the 50% retracement, never even looked like closing below it. And now where do we go? Well, I think that we retest this 47.75 area to 48.50. 48.50 is going to be a very tough nut to crack to the upside. So triangulating all these equity markets, they're all saying the same. We're going to go a little bit higher, we're going to squeeze people out, and then we see. And I think that that is the correct view to have. It's all data dependent. I don't think the data next week is going to be the one that tips it. But on the other hand, we're just going to be waiting for the week after and the week after that. It's going to take really quite some time for us to be able to determine accurately how big a slowdown this really is. And with that, onto the summary page. What have I told you? I basically told you that I'm not in panic mode, that I think the yield curve has probably stopped steepening for the time being, which allows risk markets a brief opportunity to rally. A couple of percent, nothing crazy in the SPY. And this, I think, 54.47 is going to be the big battleground, just as I think that sort of 18,875 to 19,200, 1.5%, 2% area is going to be the big battleground for NDX. And in the Nikkei, the big battleground is going to be around 37,000. I don't think stocks can go anywhere close to 4850. I think it's going to keep on failing at 4800. So that is what I am seeing and trying to triangulate at the moment. I would leave gold well alone. I'd only buy a breakdown, because I think a breakdown in gold would probably coincide with the upper levels of the yield curve and the yields that are possible, and I showed you at the beginning in the bond section. So that would triangulate somehow, and that's really all I have. I think it's going to be quiet unless the data is very surprising. And just like when, how shall I put it, when the markets tried the downside too hard, it's always quite easy to get them to go up 10, 20, 30 points in SPX as volatility comes down. As volatility comes down, people regross, but very slowly and very tentatively. Thank you very much indeed, and I'll tweet you tomorrow.